Oh, good.
Welcome to the January 18th meeting of the Rotary Club of Louisville. I'm Kevin Lynch, I'm president of the club. Please silence your phones. Former Rotarian, a lot of you might have known him, Ben Richmond. He passed away earlier this week. He joined our club in September 1988. He was presented with the Service Above Self Award at the Mayor's State of the City meeting in 2022, almost 2 years to the day from today. He served as president and CEO of Louisville Urban League for over a quarter century, from 1987 to 2015, and left a towering legacy for the city. I knew Ben pretty well. We were on a board together, the Festival of Faith, Christine Brown's board, and he was a good man. He really worked hard. He cared about people. He used his talents, made a difference. He was a humble person. He never thought he was better than anybody else, and that's really a good combination of qualities. Please, if you join me in a moment of silence for Ben. Provided our invocation is Cliff Elgin, President Cliff Elgin Consulting LLC, a member of the 1912 Society and the Paul Harris Fellow Plus and I.
When you are asked to do the invocation, you think of a lot of things that you might want to share. But last night, our motto, Service Above Self, came to my mind. 3 short words you can read in a fraction of a second. In a few more moments, you can speak it out loud. Service is the key word. The definition in the dictionary is an act or result of serving, duty performed, or need supplied. As I thought about it, I think there are 3 components. Understanding, giving what the recipients need, which are best gotten by asking them what they need. Sacrifice. In Rotary, we serve with money or time. And compassion, serving with care, concern, and empathy. Finally, when I think about service above self, I am grateful for Rotary, because Rotary is an organization that provides all of its members with a way to efficiently serve our club, our community, our country, and the world. May we continue to work together to provide service above self.
Thank you, Cliff. And leading us to the 4-way test and the pledge is Bob Fink, Assistant Director of Pharmacy Services at U of L Health and Major Donor.
Please join me in the pledge to our nation's flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. And next, the 4-way test of the things we think, say, or do. First, is it true? Second, is it fair to all concerned? Third, will it be goodwill and their friendships? And fourth, will it be beneficial to all concerned? Thank you.
And time for guests. Rotarians, please introduce yourself first, and then your guest with their name, title, and organization. And the guest, when your name is called, just stand up. And also, after the meeting, there'll be a brief meeting with a brief 5 minutes or less with Craig Sherman to tell you about what Rotary is all about in that corner table.
I don't want to introduce the press, so I want to just provide to say that a month or 2 ago, we had the pleasure of hearing David Jones Jr. talk about his dad and the book about his dad. There's a marvelous tribute to Ben Richmond in that book from David Jones at Renville.
I'm Henry Heiser. I want to introduce Mark, his Taya Cowan. Where's Taya? She is the financial advisor of Northwestern Mutual. Welcome, Taya. And is Nancy Angela here today? Are you Nancy? Hi, Nancy is with MBA Consulting Group. Is that correct? Welcome, Nancy. I believe our speaker has a guest with us as well. Hopefully we'll introduce them when you're up front. And is there anyone else in the room that is a guest with us today that has not been introduced? All right, welcome.
If you read this week's Sparks, you'll notice there's quite a few folks in the newsletters these days to celebrate. Michael Gebhardt has been named partner at Unified Technologies. J.R. Curtin, Joan Hannon, and Steve Roman and Ginger Wallace are all in this year's Encore Louisville class 2024. By the way, Steve, I think it's his 7th time doing that. He's finally done. Cindy Caudill and with Harding Szymanski was featured as one of the Louisville best first people to know in accounting and finance. That's a big deal. Alice Bridges and Eric Gurvich have joined the Parks Alliance of Louisville team. Alice is Director of Special Projects and Eric is Director of Community Relations. And Alice did a great job at the Alberto Jones grand opening celebration. And David Hardy, Managing Director of CBRE's Kentucky Operations, will moderate a panel event titled Reinventing Downtown Louisville. Congrats to all of them. I also want to mention a couple of upcoming events. We'll be back at the Kentucky Opera on Sunday, February 18th, for the matinee performance of the Pirates of Penzance, and hopefully have a backstage tour as well. And join us for a date night or treat yourself to an evening with Rotarians cooking at Millie's on Tuesday, February 20th. My question is, do you have to eat your own cooking thing? You do that? I'm not going if that's the case. And save the date for dinner and a Broadway show on April 10th. Look for details and registration links in the weekly Sparks about these activities. Mayor Greenberg's 2024 State of the City address, his first one after being a full year in office, will be in 2 weeks on February 1st at the new LMPD Summit Wellness Center on President's Boulevard. We expect to sell out, so don't wait to register. Scan the code on the screen, it's not easy. Or visit louisvillerotary.org. I'd like to invite to the podium Henry Hauser. He's got quite a few things behind his name here. Chairman of Unistar LLC, member of the 1912 Society, Lifetime Service Award recipient, Rotarian of the Year honoree, Paul Harris Fellow, and one of the best darn presidents we've ever had to introduce today's speaker.
To be part of this program today because I've been in the cheering section of our speaker for a very long time. It was almost 30 years ago when Ken Euler and I visited Cincinnati. We went to Cincinnati to meet the superstar and founder of Fund Evaluation Group. And the purpose was to meet the team and also to talk about the Henry Publishing Company Pension Fund. So sadly, Fred passed away much too early, but his culture and the company's success certainly survives him today. The Fund Evaluation Group oversees $74 billion under advisement and $13 billion in assets under management. I have a friend in Virginia who moved to Fort Worth, Texas to take over a major museum, and she said, my biggest adjustment moving to Texas was learning what $1 billion is. She said, do you realize it's 1,000 million? She learned very fast. And was very, very proud. The firm has a very heavy emphasis on research. You will be hearing from Alan in a minute, and you will understand how solid they are. So in my invitation to Alan, I explained Rotary's long tradition of using this meeting in January to talk about the past years and then looking forward. And I'm thinking of our wonderful boss Todd and Bob Horjanga, who It was just wonderful. Every year we talked, and it was such fun because I used to keep score of their predictions, and he was very frank. I had a finance professor in college. He said if you get 51% right on your investments, you're doing well. So we're in for a very special treat today. Alan Lenahan is a global native, a graduate of Trinity High School, and went to Xavier University where he graduated with a finance and marketing degree and played soccer. Alan joined FEG 22 years ago and worn numerous hats. But today is his first address as the Chief Executive Officer, which he assumed on January 1. So in addition to all these responsibilities, it's a very large company, he and his wife have 4 very active kids, and he enjoys golf when possible. So I'm really delighted he could spend time with us today. So, and be ready with some really good questions. Please join me in welcoming Alan Lenahan to Global Rotary Club.
Thank you very much, Henry. Fabulous to be invited back home by Henry to meet with such a great group. As Henry said, this is and always will be home for me. I get to go have chili with my parents after this, so I had to bring my own hot sauce. I can't wait to spend the time with them. So, I got my start in this business here downtown about 30 years ago. My father was a commodities broker for J.C. Bradford. They've opened up a few places over the years, but I can remember, I don't think I was paid for this, but I did an internship with him one summer, and sitting in his office and looking at these charts of corn futures and pork bellies and oil and gold. And back then there weren't many screens, so you actually had printed charts out all over his walls. And they were jagged all over the place. And I'm staring at these, trying to confirm trades for him every once in a while. And he'd be on the phone. And every time his client would ask the same question, Joe, where's whichever market going? And he had to, I got to hear the response over and over again. Well, it's going to be volatile in the short term. It's going to bounce around. There's going to be this news and that and that announcement. But over the long term, the trend is positive. Every single time. And pretty much that's what I'm going to tell you today. So just be prepared. It'll come full circle. But yes, wonderful to be here. We at FEG, I think Henry gave you a decent overview of what we do, but I also love, I was reading the President's letter last night, and I think the comment was, you're here to make the world a little bit better. Did I get that? That's what our clients do. Individually, we work with 250 clients. It's institutions. It's only institutions. We don't work with individuals, so the advice I'm going to give you today, don't listen to it, because I don't work with individuals. If you work with an institution, listen to that. But they heal, they educate, they save the world, they provide for communities, and being at a Rotary Club that has that same objective about approaching the world, that's what gets FEG people up every morning to do this fun investment work for the great missions, and sharing the mission with you, and being able to have the opportunity to speak to a Rotary really brings that home. I also am supposed to introduce Jeff Davis. So Jeff, my colleague, is here. Jeff works with 5-6 clients right here in Louisville, Bellarmine, the Archdiocese, Assumption High School, Catholic Education Foundation, and you're going to, where are you going right after this? Filson Society. Yes, so we've got a wonderful group of clients here in town, so I'm happy to be home and hopefully continue the great relationship we have with Louisville. So let's talk about what I'm supposed to talk about, which is the 24 investment outlook. We're going to start with a little bit of how we got here. So, a couple-year look back of what's been going on in markets, and then we'll give you ideas about what we're excited about, what we're concerned about. I'm not going to give you a top 10 or hard predictions. Again, we're institutional investors mindset, and there's going to be a lot of volatility in a lot of what we talk about. We've experienced for the last 2 years. 23, fabulous year for risk assets. 22, horrible year for risk assets. That's likely to continue. But over the long term, being invested is important, staying invested is important, and avoiding the emotional response to that volatility is important. So we're going to talk now a little bit about the short term, because I think that's what everybody wants to hear. But long-term message, stay invested through this noise. So what's bad? What's driving investment markets? It has been for the better part of 15 years now. There's one entity, the Federal Reserve Bank, and we're going to focus on the United States, the U.S. Fed, but it's globally central banks. They are the dominant force in markets. Just about everything else we read, the headlines about why a market was up or down, is usually just a made-up narrative, because the Fed's pulling the strings of the market, and they're doing that by managing interest rates and managing the economy centrally. So we want to talk a little bit about what's been going on there. The other part of the story, the Fed, by controlling interest rates are the most important variable in the value of any asset. We love this quote by Warren Buffett. I don't know if you can see it all the way. Interest rates are to asset prices what gravity is to the apple. When there are low rates, there is a low gravitational pull on asset prices. And we got to experience that for the better part of a decade. Interest rates extremely low, driven by the Fed reducing the Fed funds rate to near zero to handle the great financial crisis and then COVID. That brought interest rates down. Low interest rates mean the discount you put on the value of something that's going to happen in the future is very low. So growth companies that are producing no earnings but might 10 years from now have high valuations. Anything that's further out in time gets a higher value because interest rates are low. Well, that's changed. But let's take a look back in time historically. So over the last 2 years, interest rates have gone up dramatically. This chart is the 10-year interest rate, 10-year Treasury rate. We started 2020 less than 1%. All-time lows for the 10-year Treasury. We are ending right now at the end of 23 right at about 4%. So dramatic increase in interest rates. The biggest increase was in 22. What did we see in 22? We saw bonds drop and we saw equities drop. Interest rates up, values down. We experienced that. It hurt. 23 was more choppy, and we were able to have a good year. Let's look further back. So we started at 20 and go back in time. You can see interest rates hovered around 2.5%, 3.5% for a lot of this time, and now we're kind of back into that normal look back to 2009, but go all the way back to 1900. We're still at unbelievably low levels of interest rates. In fact, academics, and we have a podcast on our website with one of them, surmised that in 2021 we had the lowest interest rates in the history of society, going back to almost prehistoric times when people would trade rocks, and you get 2 rocks if you give me 1 back later. You can actually kind of calculate that. We had the lowest rates in the history of the world. That is what helped us enjoy such a great run in risk assets. But what happens over time when you reduce the value of money so much? Over time, you're going to have a problem. That will lead to inflation, and that has been the story of the last year and a half, and has changed the dynamic of interest rates. It also, so it's not just interest rates that generate low rate environment that leads to inflation. Global central banks also do something else other than just manipulate interest rates. They have their own balance sheet. They have their own pool of capital that they can use to buy assets to stimulate the economy. Our Federal Reserve, led by Greenspan, back in the 90s, had a nice slow rise to that balance sheet, starting at about $500 billion, grew up to about $1 trillion. Well, Bernanke came in during the great financial crisis and needed to save markets, save the system. So he grew the Fed balance sheet by another $1 trillion, up to about $2 trillion. They liked the feeling of being the superhero. They enjoyed saving the world. And Yellen came in actually and kind of paused it a little bit after the great financial crisis. But then we see what Chairman Powell did coming into and out of COVID. The balance sheet grew to $7 trillion. So we're from $500 billion to $7 trillion. By the way, the total value of sovereign debt, so U.S. debt, European debt, all the sovereign nations, their total debt is about $50 to $60 trillion. And we're talking about a meaningful amount of money put into the system buying that debt, which also helps keep interest rates low. So all of this money's flooding the system. Powell comes in, feels good about saving the day again, and just keeps saving the day to where we are now, still above $8 trillion. So there's been $8 trillion of our Fed central bank money put into the system. That led to inflation of investment markets because they buy securities. Our Federal Reserve buys U.S. Treasuries. The Federal Reserve in Sweden buys stocks. They're one of the biggest holders of Apple stock. So other central banks just buy equities. All of that helps inflate values and create some inflation. So there's another aspect to causing inflation. It's not just Fed with the interest rates and the Fed with the balance sheet. There's fiscal stimulus. Who got a COVID check? Who got a stimmy check back a year and a half, 2 years ago? I think everybody did. They just mass sent it, whether you need it or not, everybody gets a check. This is data that shows in COVID, relative to GDP, the fiscal stimulus is about 20% of GDP to get money into the system to help people through COVID. That compares to the great financial crisis, which are the blue bars, which are much, much lower. So we have attacked every problem in this country over the last decade with low rates, buy our way out of it, and stimulate our way out of it. No wonder we had an inflation problem. All this money comes into the system, you're going to devalue the base of that money. I don't know if this has a red thing. So you can see our inflation rate spiked up to 9, 10%, a bunch of different measures of inflation. Inflation is very, very damaging to economies. If you'll remember, the Fed was talking about this is transitory. Don't worry, it's going to go away, and they realized in 21 that's not the case. Inflation is a problem, and it needs to be dealt with. So now let's reverse everything we've been doing. The Fed had rates down to nothing over the course of about a year and a half, increased rates 11 times at a rate that we've never seen before. So this is a normal cycle, adjusting rates up and down, but this one was a little bit different. These are all the past 6 or 7 cycles, and the orange one is what they did in 21 through 23. Fastest hiking cycle in history to address the fastest increase in inflation since the late 70s, early 80s. So think about this is like driving a car. When rates are here, you're driving full out. It's whatever you're 150 miles an hour down the freeway. Then slam those brakes on. And what happens? Things break. And that's what we saw happen in 2022 especially. So remember SPACs? There was a term called SPAC, Special Purpose Acquisition Company. They all went, most of those went to zero. Some biotech investments went to zero. Technology in general went to zero. Cryptocurrency got wiped out. All of those speculative asset classes that relied on low rates and all this future potential got hammered. But what didn't break was the economy, surprising everybody. So last year this time, if I was up here, I would have told you consensus is we're having a recession. The recession's right around the corner. All that Fed stuff, all that breaking is going to crush the economy, and we are going to struggle through 2023. We didn't struggle through 2023. There was no recession. Why is that? Well, employment stayed very strong. There's still a lot of that stimulus money in a lot of people's banks. The consumer stayed very strong. And the consumer is the majority of our economy at this point. So strong economy, or strong employment, strong consumer, good economy, much better than expected market results because the economy kept us through it. So that's the backward looking. Let's talk about forward looking. What do we think is going to happen from here going forward? So first, what are we looking for? What are we watching for? We still got to talk about recession. Are we at an inflection point with inflation? Very important, because once again, what the Fed's going to do is going to be what is the primary determinant on market returns, and the Fed is going to do things based on where we are with inflation, and then we've got an election. There's some bourbon. Thank you for the bourbon, Henry. I'm going to try in this part not to make us drink it, especially on that last point. So will we have a recession, and if so, when? The answer is always to this question, yes. The first part of it. When is the really tough part. We will always have a recession in the future. The superheroes of the Fed think they might be able to avoid that. It's human nature. We will have a recession. I can't remember if it's Churchill's quote, but it applies in a lot of ways. Bad times make strong men make good times make weak men make bad times. That won't change. So be prepared, there will be a recession. The consensus is that it is likely to occur this year. The expectation now in markets is it's going to be what they call a soft landing. That's where we see GDP get a little bit negative for 2 consecutive quarters. You may not notice it in your day-to-day life, but everything slows down a little bit. It normalizes the economy for another rebound. You see a little bit of an unemployment increase in this soft landing. The market wants a soft landing. The Fed, the superheroes want a soft landing. That is the perfect outcome for them when they can manipulate us right into a soft landing. It's unlikely, because that's become consensus that it is a soft landing. So we expect there is a recession on the horizon, not calling for specifically the time and guaranteeing it's going to be in 2024. But because so much of the consensus thinks it's going to be soft, it'll probably not be as soft as we would like it. And anytime when there's this much manipulation to try to make it soft, something usually doesn't work out. I can't tell you what that thing is, but history tells us the more confident you are that the economy is going to be smooth, more volatile, it likely will be. So yes, all of our signals point to, except consumer sentiment. Consumers are staying fairly positive. But the other key signals that tell us we're headed towards a recession are all flashing red or yellow, inverted yield curve. You've probably seen that or heard that. It's been inverted for well over a year now. Usually I think, inverted yield curve is predicted like 9 out of the last 8 recessions. So it's rarely wrong, but every once in a while it's wrong, and it doesn't result in a recession, but more often than not it will. So all of these things are pointing to a difficult time in the economy. So we can have a tough economy. It doesn't mean markets are going to have an awful time through that scenario. And that's because if we do head towards a recession, the Fed is going to cut rates, bring interest rates down, and that naturally improves long-term value of things. This data is kind of silly, but what it told us at the end of the year is the Fed thinks that rates are going to stay higher for longer than the market thinks. So you can, through swap markets, understand what the investors' expectation for interest rates are, and they are lower than what the central bank is saying themselves those interest rates will be. So the market, when it thinks they're lower, will help support investment markets. So that's why, it's a big part of why the fourth quarter of last year we had a tremendous rally across all asset classes, was the market started to discount what they thought future rates were going to be, and that improves the value of risk assets. So are we at an inflection point with inflation? There's a lot of pros and cons to this argument. So the case for higher long-term inflation include we have a declining active labor force. The amount of people able to work is lower, it means they need to be paid more. Higher wages is an input into higher inflation. I'm not going to go through all these, there's too many. Deglobalization, I say that, I'm going to go to number 2. Deglobalization is really important. We are in a world now, we're not letting China make everything for us and reduce the cost. The geopolitical risks that are out there are not supporting the global mindset to go to the lowest cost place to produce something, and that's what we'll always do. There's too much animosity, too much risk geopolitically right now for that to be the world we're in, and it's unlikely we go back to that pure globalization world for the better part of a decade unless we and China and Russia and the Korea can be friends again, and that looks unlikely in the near term. So there's plenty of other reasons for higher inflation for longer. There are a few reasons why inflation can come down. They seem to have lower probabilities when I look at them than the reasons that inflation could stay high. Peace in Ukraine, reversal of anti-China views, aggressive Fed tightening. The Fed doesn't want to tighten. They lose their superhero. They don't support things when they're tightening. So it's unlikely that there's significant more Fed tightening on the horizon. AI, save those AI questions. We're not going to talk about it a whole lot, but in this part, exciting opportunity for productivity gains, which can reduce inflation. So when we look at the list, we believe the case for inflation remaining a little bit higher and being more difficult to fight is stronger than the case against it. We've got to experience 2% or lower inflation for the better part of a decade. It's spiked, it's coming back down. Strategas, who's a research provider for us, analyzed all the inflation spikes in developed economies over the last, I think they went back 200 years. Over 80% of the time when you see a developed market experience inflation, it's not one bout, it's multiple bouts. Now, emerging markets have inflation, they blow up, the currency collapses, it just takes them out. In developed markets, you try to manage it, you try to bring it down. Generally, there's another spike, and we believe that's the most likely outcome. Okay, the election. That's all I have to say. It doesn't matter if you can't see that. every 4 years, and I've been at FEG now for, 5 of these. Every 4 years, we write a piece, come about September, that explains to our clients, if you analyze the results of presidential election years and what that does to markets, it doesn't matter. Incumbent stays, market might go up, might go down. Incumbent loses, market might go up, market might go down. Democrat to Republican, Republican to Democrat. In every case, it's a coin flip what the market will do. But in every case, there is an unbelievable amount of angst caused by the election and the pending end of the world, depending on if it's your candidate or not that wins. So that's going to happen. And it may happen in a more severe way than any of us have experienced in our lifetimes, based on the trajectory of the candidates and the likely race that we're going to endure later this year. But there is no investment argument to be made about the outcome. One thing I can say is, after the election, there is market-moving information. There will be market-moving policies put in place. I'll never forget in 2016, there was a whole lot of angst. What if this Donald Trump guy wins this election? He's going to break the world. We had a call with one of our investment managers a week before the election. And they said, it was a week after the election, when some of the policies were being projected and discussed. And they said, look, before the election, we were in the 8th or 9th inning of an economic cycle, meaning we were close to a recession. The economy had been good, and it was about to turn. They said, based on the policies that are being proposed, we believe we're going back to the 5th or 6th inning. And that was lower tax, that was pro-business policies that would help support companies' earnings and help support their valuation. And they were very correct in that analysis. There were 2 good economic years coming out of that, largely driven by tax breaks and tax cuts and a pro-business policy. So the policy will matter, but the election itself, there's no statistical evidence that it will move markets. Okay, what do we like right now? We love bond yields. And it's, for the first time in decades, you get paid money to wait. So you can yield 5% in a money market fund. That is extremely attractive right now, especially now that inflation is below 5%. So you are earning real income by being very patient and very conservative. So yields are our friend for the first time in a long time. And as many of our clients have a fairly balanced portfolio, 70% of equities, 30% of bonds. That 30% of bonds has been dragging down their results for a decade. Now they actually can support the results for the clients. So attractive alternative to equity for the first time. This data goes back to 2008. The 1-year Treasury hovered below 1% for most of this time frame. So you got paid nothing to be patient. Technology. This has a little movement on it. So that's a Pac-Man thing. But if we go back, technology in 2013, so a decade ago, made up 10% of, about 9.5% of the market capitalization of U.S. stocks. Over the course of the last decade, it's moved to over 20% of the capitalization of U.S. stocks. We expect this blue pie, Pac-Man's mouth, to keep getting bigger. Technology is a lot of the future of both our economy and our businesses and corporate growth. So we do like technology. The problem is technology's got very expensive. way too much detail on this chart, but this is NVIDIA. So NVIDIA makes a whole bunch of the microprocessors, the chips that power AI. They also power my kids' gaming computer. They do a lot of high-tech computer chip manufacturing. They went on a massive rally last year, up to about 50 times earnings. I'm sorry, 50 times sales, which is an astronomical valuation. They actually, this data is a little bit dated. Over the last 3 or 4 months of the year, their stock was pretty flat. So it looks extremely expensive. It's rallied heavily. However, they've already started to grow into this valuation. They beat their earnings estimates, their earnings expectations by more than 50% twice last year. They're producing unbelievable profits at an unbelievable growth rate, and are kind of growing into these levels. When we look at what's going on in technology, and you get a Magnificent Seven, so it's not just NVIDIA, it's Google, it's Alphabet, it's Apple. These businesses, relative to what we saw during the tech bubble in early 2000, they're overvalued relative to the rest of the market, but relative to the height of bubble scenarios, they're only about halfway there from a valuation perspective. So while it's taking on some risk and participating in what could be a bubble, there is growth of valuation available still across technology. And when we look at what can grow in this country from a corporate standpoint, technology is clearly the leader. So we like tabulate bonds. Jeff's going to a client meeting. Thank you, Jeff. But if we think about the perspective of stocks versus bonds, and I take my long-term, the trend line is up, hat off for a minute and think about the next year or two, we would be tilting a little towards bonds. We had a great year last year. You're paid to be patient right now. Yields are high, and stocks in general are fairly expensive. So in the shorter term, we're going to continue to see that volatility, and we can be patient and find great entry points to stay involved in the stock market. And when I say this is what we are moving portfolios around by single percentage points. We don't, our client of ours that's got 70% risk assets and 30% in fixed income, we might be at 72 risk, 28 fixed. We're not making dramatic moves based on this, because long term, the trend is your friend, and stocks are the place to be for total return. Our forward-looking estimates for the next 10 years have U.S. equities at about 7% annualized return, and bonds at about 4.5%. So there still is a spread when you get out past a year or two and stay invested in stocks. Another area of interest, and I don't know how well it applies to this room, but private investing, private equity, venture capital, private real estate, other private natural resource opportunities is an area of great opportunity. Always has been and likely always will be. And that's because this pie chart you see, that's the blue are the number of private companies with revenue over 10 million, and the orange is the number of public companies with over 10 million in revenue. 96% of this market is untouchable. Of our U.S. corporate businesses are untouchable if the only way you're accessing is through public markets. It also happens to be these blue companies are more open to change, are growing more rapidly, and more information can be shared. So for institutions especially that have a long-term investment horizon, many of our clients have 20, 30, 40, 50% of their capital invested in private markets. It can be more difficult to access for individuals, but it's a great place to look for opportunities. And then finally, this is the final slide, and it's little tiny small. So this is the way we assess markets. We look at markets from a valuation, a fundamental, and a sentiment approach, and we red, green, yellow, light, and there's some numbers behind it. If you look at it though, what you can see, just zooming out, is there's very few areas where there's two green positive signals. And really, I think the only one, tips, but we won't touch on tips much, but within fixed income, we see both fundamentals and sentiment being positive. Outside of fixed income, either valuations are struggling or too high, or fundamentals in that business we think are struggling or are a problem. So this doesn't get us too excited about anything except what I led to, which was bonds, a little bit more attractive right now than stocks, and the largest large cap are the most overvalued but the highest growth, especially when you look at those magnificent seven. So I'm going to pause here and see what questions you have about anything I talked about, any other topics anywhere in the investment landscape. I'll try to answer, or I'll get Henry to help.
Turn it on.
Mike Rowley, thank you. You answered so many questions during your speech. I had one that I wanted you to kind of elaborate on. We've heard that debt's not a problem. Several groups. Is it $33 trillion a problem? And can we make it $100 trillion? I mean, is our currency so strong that we can do anything we want?
It is a problem. There was a lot of hype around the concept of modern monetary theory a few years ago, which was the concept that it doesn't matter how much debt we have. We could have $100 trillion in U.S. debt and just keep printing our way to a glorious lifestyle for every American. Fundamentally, cognitively, I wish it was that easy. It can't be that easy. I'm not the economist to tell you exactly why. You just know something in your gut when it's that wrong can't work. We are already, and most of that commentary was made back when interest rates were near zero. At the level of interest rates we now have to pay on our sovereign debt, we will bankrupt ourselves if we keep growing at the level we have grown. We are the strongest economy in the world. We have the strongest currency in the world. And I think people understand this, but the reason our bonds are considered the risk-free asset, closest to risk-free asset in the world, is the taxing authority of our government. So can we pay back the interest on our bonds? Yes, because the government can tax us to do that. At some point, that's not going to work. If we continue to grow that and the rest of the world calls our bluff, says, I want my money back, I want it now, don't print more, don't issue more bonds to pay me back, which is what we do, and says, I'm not accepting that model anymore, I want it all back, well, yeah, our tax rates can go to 90% and the government will raise the money to pay it. I don't think that'll go over very well in the country. Thank you.
You gotta turn it back off.
Hold it to your-
I turned it off.
Now maybe.
Yes.
Okay, thank you. Larry Sloan, and enjoyed your presentation today. I do have a question about this thing that's called ESG, environment, social, and governance, that has become a political football in places. And I wonder if that's going to affect very many stocks. But the second to last slide you showed that the stock market is really a tiny percentage of the total wealth in this country. And that begs a second question. I'm sorry, I break my rule and ask you two questions. But how can the average investor invest in some of this private equity is the second question.
Okay. Thank you, Larry. So start with ESG, absolute political football, and if you imagine the clients we work with, being not-for-profits, some are very focused on saving the environment. So we've been involved in that space for a long time, and some of our clients, I work with a client in Dallas, Texas, that could care less. We're gonna reduce as much oil as we possibly can. So we've got a wide spectrum. FEG's responsibility is to react to what our client's mission is and have solutions for them. And if they want to align their investment portfolio with their mission, we will help them in that cause. So we have ESG portfolios. We have portfolios that we have built that do the best we can to screen out and eliminate fossil fuels and invest with corporations with great governance, et cetera. It is a political football. I think the dream for the ESG movement is the environmental and social and governance variables that can be measured on companies would be very tightly understood and measurable, and then the market would support those companies that are strong ESG firms with a higher valuation, with a premium to the rest of the market because they're good and fair in saving the environment. That happened a little bit for a little while, but it became very apparent to just about everybody that the price of oil is the dominant factor. And when oil was declining in value, ESG looked like a good strategy that might have a long-term higher return than a non-ESG equity strategy. That worked when oil was going down. When oil was going back up, ESG strategies struggled because they had no exposure to oil. So it kind of lost some of its, not credibility, but it lost some of the momentum and excitement because all the ESG investors underperformed. We'll keep seeing that cycle. I don't think it breaks anything. I think it is a political football, but investors should be and can be allowed to invest with their heart and their mission, and that's a fine way to approach the market. From a private capital standpoint, there are, and full disclosure, we have ways to provide some access to individuals. There's platforms out there that advisors, investment advisors can access. And then there now are more and more publicly listed closed-end interval funds that even have tickers that try and do deliver private capital. There's a massive trade-off, though. When you invest in real private capital, you're giving up liquidity. You can't buy private capital 1 month and sell it the next. To do it properly, you invest in private capital and you hold it for 10 years. And you get money back out after 10 years and after these businesses have grown. So if you have the ability to accept a very long-term, illiquid asset that has growth potential, there are platforms and there are funds now available that are providing that. Thank you.
Thank you. Thank you for your talk. It's one of the better ones that I've heard. Maybe that's because you are an economist.
Sorry for the charge. I try to pretend.
My question, though, is when I turn on the news, it's filled with chaos and conflict, international conflict, Israel, Ukraine, Korea, all these things. Yet when I look at the stock market investments, it does not seem to price any of that in. And I'm curious, why do the markets, especially in 23, not price in the risk, that sometimes existential risk that exists there? And should we be concerned about that?
Yes, so it does depend. If we are looking at U.S. markets, the S&P 500, the Dow, those markets have skated right through all the geopolitical risk. Now, underneath, we've seen companies with Russia exposure when that war began take it on the chin. Russian equities themselves almost all went to zero because foreigners were oh no, we're not allowed to own Russian securities, so they got wiped out. So underneath the headline indices, there are some pain points. And then when you look at local markets, the Chinese equity market is down 50% from its highs right now. There was no rally in China in 2023. China's positioning themselves in geopolitics. They paid a pretty hefty price in their equity markets with foreign money leaving. A lot of it being because of concern that you may not be able to get it out if the CCP decides they don't like outside investors anymore. So there are pockets of pain, especially in some of these international markets. But the net effect, there's the rumor talked about for decades in U.S. equity markets is war is good for companies and market returns. It's a GDP enhancing defense spending benefit to domestic companies. And it's not rarely had a significant negative impact across the index level on U.S. stocks. Now, a large enough conflict, all bets are off. If we see escalation and we see the potential that the U.S. is pulled more and more into these escalations, watch out, volatility will spike, and just the concern there would be a negative factor.
Hi, my name is Kent Wayland, and our family operates a local real estate development company. We interact with a lot of local businesses, and most of the investment we see in those businesses in real estate tends to be private investors locally. Given that you represent funds at a national, it seems international level, and you have a background of being from here, we often hear that the Ohio River Valley or this area of the region isn't the best location in the world for incubation of startup tech companies or getting private investment from big funds from New York to come invest even in our local real estate or our local businesses. From a fund management standpoint, what kind of things and factors would you advise local businesses or the local infrastructure emphasize and focus upon to be able to become attractive to that kind of institutional capital coming to our ecosystem?
Where's the Chamber of Commerce? We need to go talk to them.
From a person buying that standpoint,
Yeah.
rather than from leading it out, because you'd be the one who would be having clients who would want
Yes.
to buy something like that. What would they be looking for, and you would advise them in that way?
Yeah, so we have investments in most regions purely from a real estate perspective. We like to invest with real estate managers because we're an allocator. We're not buying the properties. We're investing with managers that buy properties and build portfolios. We are national, well, global, but in the U.S. we have a national footprint there, and we don't want to pick and choose sectors. So we have plenty of real estate investments in the Midwest, in the South, likely in Louisville through those managers. But these are not the highest growth regions, and that's why I say the chamber. What is really going to drive a difference? And Cincinnati is pretty much no different than Louisville from this kind of conversation. It's attracting talented workforce into industries that create the kind of booms that come at a cost that you've seen in Austin and you've seen in Nashville. It's government support to grow industries that are high growth rate, bringing young talent in, that are growing a dynamic, younger workforce that needs more property, more places to spend money, more shopping, more strip malls, all the things that are the infrastructure that needs to be there to support that. So I do think generally the answer is government and chamber support to build exciting job prospects for kind of those younger generations to move to these great cities.
Thank you.
Excuse me, my name is Fred Cowan. I have two questions that are related, at least I think they're related. The first relates to an item in the news lately, but it's part of a long-range trend, which is the fact that some people are predicting that by the end of this decade, one of our mega wealthy people in the United States will actually have $1 trillion in assets, which is much more than Saudi Arabia here. And secondly, included in that is the growing disparity in wealth that we've recognized in the last 25 years in this country, or maybe even more. So my first question relates to whether you see that trend as having any impact on investing and the direction of the market. And then the second one, to see how it relates, the first one is with EVs, with electric vehicles, whether you think that all the discussion we've had about them in the last few weeks in terms of people, major auto manufacturers cooling off on them, now they're having trouble getting Tesla started in Chicago because it's too damn cold, whether those factors influence market behavior in your investment strategy.
Now I'm going to go to City Hall and talk to some politicians for the first one. If we have a trillionaire, look, it just depends on who that trillionaire is, whether that's a good or bad thing, I think, but won't affect how we invest. We hope we're invested in whatever company makes them a trillionaire. But I don't see it affecting markets in general, which is how we're approaching the world. On the EV question, full disclosure, I have an EV, and I did not drive it because it would not have made it down here. So that's a real thing. EVs, especially kind of north of this region, are people are learning some lessons. And it was the last hike. I mean, think about when I talked about how when the Fed hikes, things broke. We had crypto's on and off been the hype bubble machine. But there was a period of time, I think it was 2021, when EVs were the bubble. And Tesla was through the roof. Rivian, before people were buying Rivians to get access to the IPO, which opened at $50 and it's trading at $5 now. Like that was a bubble. My brother works for Toyota. Hybrids are the future. I could talk about cars way too much. I love talking about cars. It's such a small piece of the global investable market. We don't look at sectors like the automobile sector and try to make a call. So I don't have an investment call, but EVs are really fun to drive and fly in. They just don't get you everywhere you want to go.
Last question.
Last question. Alan, in my introduction, I did not mention something very special, which is what you do with your company, and that is this amazing national conference bringing great thinkers, investment gurus in the world together. And your last one, 23, I was amazed at the presentation on the growth of nuclear power and related industries. Can you mention something about that? Because it was a total surprise to me.
Sure. So we invest in real assets as an asset class for us and how we invest for clients. In real assets, we have many categories: traditional oil and gas, real estate, and then less traditional or unconventional green energy opportunities. So there's a blend of some solar, some wind, and then we have exposure and sourced a great manager that is investing pretty heavily in the redevelopment and the maintenance of our current nuclear power capability. We haven't, although it's being heavily talked about and likely to become more popular again, nuclear power generation is about as green as it gets. but nobody forgets that there have been meltdowns, so there's been plenty of public and policy response to restrict that growth. But we have 40, I think it's about 40 operating nuclear reactors right now. They're all old, they all need a lot of work and maintenance to stay online, and there is definitely a demand to keep them online. A lot of our green resources for power generation do not provide a consistent load. If it's not sunny and not windy, you're not getting the power generation you need out of those. You need consistent load producing energy sources, and we have two really right now: fossil fuels and nuclear. So as long as we can embrace and ensure safety around the nuclear design, and there's a whole lot of work going on micro nuclear reactors that can just take up small space, be very safe, and we can spread those around. But the manager we invested with is really doing picks and shovels work to maintain our current nuclear capacity. It's a mom and pop small businesses that have existed for 40 years, and they're bringing them together and creating a great deal of value and cost savings by rolling these great businesses up. So we're positive on the potential for nuclear, and positive on the investment return potential for nuclear. One thing to say, and thank you, Henry, we did have our conference last year. Oh, it's gone. If you go to our website, we have some of the takeaways from that conference. We do some podcasts. My favorite was Ben Hunt, who talks about narratives and avoid getting sucked into the stories that the world wants to tell us and wants us to believe. He's fascinating. We have a podcast with him. Really enjoyed that. But I think thank you all very much.
That was fantastic. You know, what to me was different about that than you hear from a lot of investors, a lot of managers of investments, and people that have individual clients. One thing he said that very few investment advisors who individual clients will say is that he doesn't change asset allocation more than 1 or 2%. He's looking at the future, looking at other things, and he's not joking. It's volatile, et cetera, and it's going to be going up and down, and eventually it'll look good long term. But you can't put dates on that, and if you're doing too much in terms of moving your asset allocation significantly, that moves more towards gambling than long-term investing. So I thought that was a great comment. Frankly, I don't usually hear that from typical investors. I thought that was very enlightening, really. That was great. So next week, January 25th, featured Shelley Zagart, who started Kentucky of the World. She's the CEO of Kentucky of the World. She's also done a bunch of other stuff, which isn't mentioned. We'll talk about that next week. But register by noon on Monday for that. And also, don't forget, 2 weeks from now is the mayor's State of the City address, so that'll be popular, so you probably ought to sign up for that fairly soon if you want to make sure you get in. And then the last thing is, any of the guests, just meet with Craig Sherman over in the corner that's empty, the table that's empty. Appreciate a good meeting.